Markets are rallying, China is back in play, and global investors are torn between tariffs and trillion-dollar tech. Are we witnessing a short-term rebound or a structural shift in the world economy? The Asian equity markets staged a noticeable recovery following the announcement of a temporary tariff truce between the United States and China. Both economic powerhouses have agreed to pause the imposition of additional tariffs for 90 days, a move that has injected renewed confidence into investor sentiment across the region. The market's reaction was swift and pronounced. Indices in Shanghai, Hong Kong, and Seoul moved higher on the news, indicating a collective sigh of relief across trading desks in Asia. This truce, although temporary, is being interpreted as a signal that geopolitical tensions may ease, at least in the short term. But beneath the surface, the market's optimism is laced with caution. With no binding resolution in place, the 90-day ceasefire is a window of negotiation rather than a final deal. Analysts warn that failure to reach a lasting agreement could reignite market volatility just as quickly. From a macroeconomic standpoint, this development comes at a critical time. China has been facing economic headwinds, including slower industrial output and weakening domestic demand, while the US grapples with inflation persistence and political pressure ahead of an election cycle. Any progress in bilateral relations is thus not only market-moving, but politically strategic. And as markets breathe a sigh of relief, capital begins flowing aggressively, right into one of the most sensitive sectors of the modern economy, semiconductors. In the wake of geopolitical developments involving US defense agreements in the Middle East, semiconductors have re-emerged as the centerpiece of global investment flows. Leading the charge is Nvidia, whose market capitalization has now surpassed $3 trillion, reinforcing its position among the world's most valuable companies. The renewed investor focus on chip makers stems not only from AI demand and data center build-outs, but also from a strategic realignment of military and dual-use technologies. Recent defense contracts, though vaguely detailed, signal a deeper integration between national security imperatives and private sector innovation. This surge reflects a broader tech financial convergence, where hardware makers are no longer viewed merely as component suppliers, but as geopolitical enablers. In this climate, Nvidia isn't just powering the metaverse, it's underwriting the future of strategic deterrence. Convergence, where hardware makers are no longer viewed merely as component suppliers, but as geopolitical enablers. In this climate, Nvidia isn't just powering the metaverse, it's underwriting the future of strategic deterrence. However, this momentum raises questions about valuation sustainability. With chip stocks rallying sharply, investors must weigh growth fundamentals against hype-driven multiples, especially in light of tightening monetary policy. But while US chip makers bask in capital inflows, global investors are quietly recalibrating their exposure, this time turning their gaze back to China. Investor sentiment toward China is beginning to shift. Despite lingering concerns over geopolitical tensions and regulatory opacity, global funds are cautiously re-examining opportunities in the Chinese market, particularly in the technology sector. Giants like Tencent, Alibaba, and JD.com have regained attention, supported by favorable policy signals and early signs of earnings recovery. This re-engagement is not without calculation. Beijing has rolled out a series of pro-growth measures, ranging from liquidity injections to relaxed oversight on digital platforms. The objective is clear: stabilize capital markets, restore confidence in private enterprise, and reinvigorate economic momentum without resorting to large-scale stimulus. Foreign investors are taking notice, with US markets appearing overbought and the Fed maintaining a restrictive stance. Relative valuations in China are becoming more attractive. In particular, the tech space is seen as a beneficiary of both regulatory normalization and domestic consumer resilience. Still, the approach is highly selective. Structural risks, such as property sector instability, aging demographics, and ongoing decoupling pressures, remain in play. Yet for some, the combination of depressed valuations, policy clarity, and strategic national focus on technology is enough to justify a renewed but measured allocation. In short, Buy China is no longer a broad brush macro trade. It has evolved into a targeted, policy-aligned, tech-led strategy where conviction remains cautious, but the asymmetry of potential upside is too significant to ignore. And as China's tech narrative regains momentum, JD.com is emerging as a standout, translating policy into performance with its fastest revenue growth in years. JD.com has recorded its strongest revenue growth in 3 years, propelled by a fresh wave of domestic stimulus from Beijing aimed at reviving consumer demand. Government-backed incentives, including digital coupons, targeted tax relief, and e-commerce subsidies, have played a key role in accelerating online retail activity, placing JD.com at the center of China's demand-side recovery effort. This growth is more than just a quarterly anomaly. It reflects the effectiveness of China's recalibrated fiscal strategy, which favors selective support over broad-based stimulus. Unlike previous years dominated by infrastructure-heavy packages, this round is consumer-facing, designed to shore up confidence and spending from the bottom up. JD.com's performance also underscores how policy clarity can unlock operational leverage. While rivals remain cautious amid lingering regulatory fatigue, JD.com has capitalized on policy alignment, positioning itself as a reliable channel for government-backed consumption strategies. However, the durability of this rebound is still uncertain. With China's consumer sentiment recovering unevenly and global growth forecasts under pressure, the sustainability of JD.com's momentum will depend on whether stimulus translates into long-term behavioral shifts, not just short-term spending spikes. But even with policy-fueled gains, investors remain wary because stimulus alone may not guarantee stability in a market still shadowed by tariff threats and global uncertainty. Investor sentiment has turned tentatively positive as global markets rebound on the back of easing trade tensions and coordinated policy efforts. However, beneath the surface, there is a persistent sense of caution surrounding the sustainability of the recovery, particularly in light of unresolved tariff regimes and corporate uncertainty. The recent 90-day tariff truce between the US and China has alleviated immediate pressure on global supply chains, but it has not resolved core trade disputes. Significant portions of existing tariffs remain intact, and companies, especially multinationals, are still navigating a volatile regulatory environment that complicates long-term decision-making. As a result, many corporations are adopting a wait-and-see strategy. Investment plans are being delayed, inventory levels recalibrated, and operational risk buffers increased. This strategic hesitation underscores the gap between asset price optimism and boardroom pragmatism. Moreover, long-term risks from tariff persistence could resurface in the form of margin erosion, supply disruptions, or renewed inflationary pressure, particularly in sectors dependent on cross-border manufacturing. Investors, while encouraged by market momentum, remain acutely aware that without structural clarity, the current recovery may prove fragile. And while investors weigh global risks, regional players like Sony are making bold financial moves, though not without raising eyebrows. Sony has announced a 250 billion yen share buyback program aimed at reassuring shareholders, just as it lowered its operating profit forecast, falling short of market expectations. The contrasting signals, weaker earnings guidance paired with aggressive capital return, have triggered a split reaction from investors. The profit downgrade reflects challenges in multiple segments, particularly in consumer electronics and entertainment. Slower global demand, FX headwinds, and production costs are compressing margins. While Sony remains fundamentally strong, the earnings revision highlights the headwinds even well-diversified firms are facing in a volatile macro landscape. To offset the disappointment, Sony's buyback is being positioned as a signal of financial resilience and a tool to enhance shareholder value. In an environment where organic growth is decelerating, capital return strategies are increasingly viewed as a proxy for confidence in long-term fundamentals. Still, analysts warn that buybacks alone may not fully mask underlying structural issues. Without clearer growth drivers in core verticals, Sony's valuation could remain range-bound despite capital returns. The market is seeking earnings quality, not just financial engineering. And while Sony turns inward to stabilize its share price, global investors are shifting outward, pulling capital from safe haven currencies as risk appetite returns. As global risk appetite returns, traditional safe haven currencies are coming under pressure. The Japanese yen, long favored in times of uncertainty, has weakened notably against the US dollar and regional peers. In contrast, pro-cyclical currencies like the Australian dollar are gaining ground, reflecting renewed investor confidence in risk assets and global demand recovery. This rotation is being driven by the perception that downside risks, while not eliminated, are currently contained. The recent US-China tariff pause, stable macro data out of Asia, and corporate earnings resilience have shifted capital flows away from defensives and into growth-aligned positions. For Japan, the weakening yen poses a double-edged sword. While a softer currency can enhance export competitiveness for manufacturers like Toyota or Sony, it also amplifies import costs and may weigh on real household income, particularly in a high-inflation global environment. Moreover, the pace of yen depreciation raises questions about policy response. The Bank of Japan remains cautious on tightening, and any further divergence from the Fed's path could exacerbate FX volatility, especially as investors shift aggressively between yield-driven assets. And as capital shifts away from safe havens, a deeper question emerges. Can America's outperformance continue, or is the age of US exceptionalism fading? A subtle yet significant rotation is unfolding in global markets. As investors diversify away from US assets and reallocate exposure toward emerging and Asia-Pacific markets, notably China, the long-held assumption of US exceptionalism is being quietly but firmly reassessed. For over a decade, the United States has been the undisputed epicenter of global capital, innovation, and earnings growth. But in the current cycle, macro headwinds, ranging from persistent inflation and high interest rates to fiscal gridlock and geopolitical fatigue, are chipping away at the perception of unshakable American dominance. Meanwhile, policy recalibrations in China, a more open stance in India, and tech-driven growth stories in Southeast Asia are gaining traction. Investors are not abandoning the US, but they are hedging. The narrative is shifting from America first to America and others. The broader implication is that global capital is no longer anchored by ideology or legacy, but by relative opportunity and policy credibility. For the US, this is a moment to prove that its exceptionalism is not just historical, but also adaptable. From tariff truces to shifting trade routes, a new world order in global economics is no longer speculative. It's already taking shape, one supply chain at a time.